Let's see our first example for IS1, Experts Limited. Experts Limited has been in mining for several years. They have, however, been in the unfortunate position of not retaining a permanent accountant for more than 4 years. As a result of this, different accountants with different interpretations of IFRS have been preparing the financial statements. You have been tasked with correcting all the erroneous interpretations to ensure that the financial statements are fair and relatively free from error. Management provided you with additional information relating to the current financial year. Now, let's see what is required. I beg your pardon. Using the information provided above, discuss Experts Limited's compliance and or non-compliance to IS1's general features. So it's all about the general features of the financial statements for the year ended 31 December 2013. Provide clear headings to identify the different general features. In your discussion, also refer to whether the financial statements of Experts Limited achieve fair presentation and compliance with IFRS. So they want general features. They want you to do it separately because they want clear headings and a discussion. And at the end of the day, they want to know whether they have achieved fair presentation. Great. Now, we've already learned that there are different interpretations over the years as a result of having too many accountants. Now, obviously, that shouldn't happen because all accountants should follow IFRS and IS. So, basically, the fact that I have 1 or 5 or 20 accountants shouldn't have made any difference. Let's see what happened. Recent developments in the mining industry have led to international investors withdrawing their funds from mining activities. Experts Limited has not been able to secure any new contracts for a period of 3 years now. The shareholders have recently been in discussions with the board of directors to evaluate the effect that ceasing trade would have in the future. There's another one. What will happen if trade ceases? Management remains optimistic and feels that once stability in the industry returns, investors will return. Great. So what is the general feature that we can actually see that this first paragraph is based on? Now that doesn't take a genius to figure that one out, and that is all about the going concern principle. Will this entity exist in the future? Now, what do you think? Will they? Are we going to compile our statements for 31 December 2013 on a liquidation basis? Or are we going to use the normal historical cost principle in order to compile our statements? But let's see. Is management in the process of closing the entity? And the answer is no. What did management do? They just had a meeting to discuss what is the impact of this lack of new contracts in the future. So what is going to be the impact in the future? Have they made a decision to close the doors? No, definitely, because they remain optimistic that once stability is going to return to the industry, the investors will return and the industry will once again perform extremely well. So, do you think that there are grounds of preparing the financial statements on the liquidation basis? No, I would not think so. So, in your answer, you're going to describe it very clearly. What is the general feature? Going concern. When preparing financial statements, management shall make an assessment of the entity's ability to continue as a going concern. An entity shall prepare financial statements on a going concern basis unless management either intends to liquidate the entity or to cease trading or has no realistic alternative but to do so. So what is our conclusion? Although the shareholders and directors have discussed the effect of ceasing trade, no decision has been taken to cease trade, and management is of the opinion that the entity will continue to exist in the foreseeable future. The financial statements will therefore be prepared on the going concern basis. Can you clearly see how you have to set out everything very clearly in your discussion? You will probably have earned here a half a mark for that, a half a mark for that, for intents to another half a mark, and a half a mark. So this first sentence could have been easily 2 marks. Then your conclusion, a half a mark, and half a mark, and half a mark, another 1.5 mark. So just these 2 paragraphs, at least 3.5 marks. Right, the next bullet. The previous accountant recorded sales only when money was confirmed to have been received in the bank. You also applied this principle to the payment of expenses. He was of the opinion that you cannot mislead investors by showing money not yet received. So what is the general feature? Very clearly that comes to play here. Very, very clearly, we do not prepare an accounting. We do not use the cash basis for the preparation of financial statements. What do we use? The accrual basis for preparing financial statements. So the general feature, accrual basis. A transaction shall be recognized when it occurs and not only when cash is received or paid. Now, here I would have liked a little bit more of expansion. I would have liked it to write here, income is recognized when it is earned and expenses are recognized when it is incurred. An item is recognized in the period in which it satisfies the definition and recognition criteria of an element of the financial statements. What is our conclusion now? According to the accrual principle, the sales and expenses, and these sales there we can replace with income. The income and expenses should be recognized in the period in which they occur. Right. Third bullet point. Experts Limited sold mining equipment not in use to one of their creditors. The accountant offset the amount owed to the creditor against the value of the equipment sold. Now, is that such a big sin? The net effect is included in the balance of trade and other creditors. So I owe you some money. Instead of paying you, I'm going to sell some of my equipment and I'm going to put off the selling price of that equipment against your creditor's account. So what do we do here? What is the issue on hand here? The issue on hand is offsetting. An entity shall not offset any assets and liabilities or income and expenses unless it is permitted specifically by IFRS. The value of the equipment sold should be shown separately as a profit or loss on the sale of the equipment in the statement of profit and loss and other comprehensive income, and it should not be offset against the creditor's balance. What can we offset against the creditor's balance, guys? The proceeds. So what are we going to do? We're going to dispose of the equipment like normally. Going to take the cost price out of the books, accumulated depreciation out of the books, going to take it to the asset disposal account. Whatever the value is of the creditor's outstanding balance, well, that is, we're going to take that to the asset disposal account. So we will debit the creditor's account, but not with the value of the equipment, not against the equipment. What is that? The proceeds is going to be the outstanding amount on the creditor's account. So we will debit the creditor's account with that amount, and we will credit the asset disposal account with that amount. So what are we going to show at the end of the day? We're going to show very clearly the profit or loss on the disposal of the equipment, and on the other hand, we will not have an outstanding creditor anymore because we have settled the outstanding debt. Due to the different accountants being employed over the past 4 years, Exports Limited has been reporting their financial information on an irregular basis. The latest financial statements were prepared for the year ending 31 December 2012, and if you remember correctly, we are now here 31 December 2013. So for the last year, we did prepare a set of financial statements, but clearly this is not something that happens so ever regularly. So what is the general feature that we have in IS1? IS1 states that financial statements should be prepared frequently, at least on an annual basis. And what is the year, the 12 months that we're talking about? That is the 12 months preceding the financial year end of the entity. So frequency of reporting: an entity shall present a complete set of financial statements, inclusive of comparative information, at least annually. Experts does not comply with IS1 due to the irregular reporting of financial information. If the financial years change, the following should be disclosed: the reason for the change and the fact that comparative info is comparable or not comparable. The last one here: irrespective of the different accountants, the management of Experts Limited has always been consistent from year to year regarding the disclosure of comparative information. So what we do, one little star for you, at least you have adhered to this general feature. And what is the general feature? Comparative information. And the other general feature is consistency, but that consistency in IS1 is about the accounting treatment of items. Now, they didn't mention that. They're only saying that they're consistent in the disclosure of comparative information. So comparative information: an entity shall present comparative information in respect of the preceding period for all amounts reported in the current period's financial statements. Conclusion: management has complied with IS1 by providing comparative information. Now that is not the end of the story, because there we've only discussed the general features with clear headings, but we haven't said in our discussion whether the financial statements achieve fair presentation and compliance with IFRS. Now clearly we've seen that they definitely do not comply with IFRS, but can they still have then fair presentation? Now, first thing that you have to discuss is what is fair presentation. Financial statements shall present fairly the financial position, the financial performance, and the cash flow of an entity. Fair presentation requires the faithful representation of the effects of transactions, other events, and conditions in accordance with the definitions and the recognition criteria of assets, liability, income, and expenses, and that is according to the conceptual framework. An entity whose financial statements comply with IFRS shall make an explicit and unreserved statement of such compliance in the notes. An entity shall not describe financial statements as complying with IFRS unless they comply with all the requirements of IFRS. Not only some of them, all the requirements of IFRS. So you will see that in your accounting policy note, or just before your accounting policy note, the entity has to declare that it is actually IFRS compliant. And you cannot choose what IFRS statements you want to comply with and what you don't. So either you comply in full or you are not compliant. So that is as easy as that. So what is the conclusion? The management has not complied with the accrual principle. Management has offset amounts that may not be offset. Management does not report regularly on financial information. Since the definitions and recognition criteria of elements have not been followed, fair presentation has not been achieved, and management cannot make an explicit and unreserved statement of IFRS compliance in the notes. So you have to discuss once more in conclusion where they are not compliant, And then you must say what is the prerequisites of fair presentation. The definition and the recognition criteria of elements should have been complied with as set out in the conceptual framework, and then if not, and they have not adhered to the other general features of financial statements set out by IS1, they can never ever be compliant. In this question, they haven't asked from you to write a memo or send an email, but if they did, then at least you know that you have to, if they ask you to send an email, I refer you back to the conceptual framework of the first semester, you would have written to somebody, from somebody, subject matter, date, and then you would have written it in the format of an email. If I've asked you to write a memo, you would have had your address, you would have said there, dear Mr. So-and-so, in respect of IFRS compliance, then you would have answered the question and you would have ended up with your sincerely S student or F financial advisor, whatever you want to call yourself. So please have a look, whatever the question asks. If I ask you an email or a memo, then you write an email or a memo.